How's it going, everybody? It's Stas here, and in this video, we're going to be talking about some stocks that I'm buying right now in the middle of this crazy stock market crash that we're experiencing here in 2020. And I also want to go over, in general here, my mindset, kind of what's going through my head when it comes to making these investments and why I'm picking these types of stocks. It's very important why I'm picking these stocks, kind of based on the environment that we're in right now in terms of our economy, and honestly, with a lot of risk being in the stock market. These are investments that I think are lower risk. And if you guys stick till the end, I'm going to go over an ETF and a REIT that I'm also watching and that I've been buying here during this crash. And in general, in the end of the video, I'm going to go over kind of some other things that I'm doing with my money to hedge against the stock market a little bit, to hedge against the economy and the potential crash that we could see, maybe an even further crash. So if you guys enjoyed this video, as always, hit this like button down below, turn that like button blue, and also consider subscribing. And if you want 2 free stocks from Webull valued up to $1,400, hit that affiliate link down below in the description box, deposit $100, and you'll get your free money. So the stock market in general, taking a look at the S&P 500 in the past 30 days alone, is down from $3,400 all the way down to nearly $2,100, and now it's rebounding back up to about $2,500-ish. So overall, it's down about 25% as of right now when I'm recording this video. And obviously, when the markets go down, that means individual stocks are getting crushed as well. Some more than others, right? Some go bankrupt, some go down 70%, some go down 10 to 15%. And being a long-term investor, this is what I'm looking for. I'm looking for blood in the streets so I can come in with cash, because being an investor, part of it is kind of saving up cash for future opportunities. And when we get those opportunities like now, that is when we're deploying the capital, right? That's when we're buying, at least adding a little bit into the stocks, right? So let's get right into it in terms of what I've been buying. The first stock is PepsiCo, and this is one that I've been wanting to add to my portfolio for a couple years at this point. I didn't buy in here in the low 90s back in 2018, back in May of 2018, and when we rallied all the way up to 150, I told myself, next time we get a substantial dip in Pepsi, I want to add some money into it, especially being towards the end of the economic cycle, right? Being in a company like Pepsi, I think, is a smart idea because it is a blue chip company, right? It is a quote unquote safer company. So with the CV going on, we all know what that is. Markets getting rocked. The economy is pretty much halted at this point. Obviously, businesses are still operating, but many businesses are affected. You know, we got that big drop in Pepsi, so I figured now's the time to buy. And I was buying a lot in the lower hundreds, right, over these past couple of days. I haven't been buying a lot, actually, but just nibbling in, dollar cost averaging in. And if we just take a look at the stock price very quickly before we talk about why I like Pepsi, take a look. We haven't been in this low 100 range since 2018, which again, I missed my opportunity. But before that, it's been since the 2015-2016 time period. So it's been a couple years since Pepsi's dropped. And since 2015, 2016, the business has grown. They've grown revenues and they've grown profits, meaning a lower share price gives you a better value in the present time, right? So share price in the hundreds, that is a decent value in my opinion. And let's hop into some products that they have, which are, in my opinion, consumer staples for the most part. Sure, people can go without these products, but in a recession, in a down period, I'm thinking people are still going to be buying these products. Let's be honest, right? Their brands include, obviously, Pepsi soda and all of the different variations of that. Lay's, Mountain Dew, Doritos, Gatorade, Tropicana, Aquafina, which is water, Cheetos, Ruffles, Tostitos, Fritos. They have a partnership with Starbucks where they have that little coffee in the glass. You guys know what I'm talking about. And they have plenty of more products on top of that, right? So they're not just in soda. I like Pepsi because they're diversified across many snacks that throughout the American household, let's be honest, a lot of these snacks are staples, and I don't see them going anywhere, right? And on top of that, they have a pretty attractive dividend, right? At this point, their dividend yield is 3.18%. Annual payout is $3.82. That's what they pay every single year. Well, at least this year, for how many shares you have. So let's say you have 10 shares of Pepsi, you're getting about $38 per year, and their payout ratio is 65%, meaning they pay 65% of their net income in a dividend. So that's pretty good. If their earnings get cut a little bit, they still have enough room in their payout ratio to pay the full dividend. So that's pretty good. And either way, I think Pepsi's dividend is pretty safe here. Their 5-year dividend growth rate is nearly 9%, 8.4% to be exact, which is great, especially for a company that's been growing their dividend here. Take a look at this. Very awesome. For 47 years, guys. 47 years. And what that tells us is they've been paying their dividend and increasing their dividend through tough times, through recessions, which us being pretty much in a recession at this point, this is the type of stock that I want to own, right? Being more, again, of a blue chip company, more of a safe, quote unquote, company, spitting out that cash flow. That is what I want to be invested in. And you'll notice that about all of the stocks we're talking about in today's video. They're not some of these crazy tech growth stocks. They're stable companies. They're stable blue chip names that have made it through recessions, right? So let's get to the second stock that I am buying right now. And you guys know this one. It's Johnson & Johnson, ticker symbol JNJ. And just like Pepsi, this is a company that is a blue chip. It's been through recessions in the past, and when it comes down to their business, it's split into these three segments. We have the pharmaceutical segment, anti-infective, cardiovascular. These are some of the segments within the pharmaceutical segment. Contraceptive, gastrointestinal, immunology, metabolic. Then the next business segment is the medical devices segment. Major products include orthopedics, neurology type of medical devices, general surgery, biosurgical. Then we have the consumer segment, which a lot of these consumer products, guys, they're staples, right? Major products include baby care, oral care, skin care, wound care, and then when we actually look at the brands, I know you guys can recognize these brands, right? Benadryl, Aveeno, Band-Aid, Neutrogena, Listerine, Johnson's, Baby Line, the baby lotion, the shampoo, all of that good stuff. These are all brands that, regardless of the economic cycle, people are still going to be buying them, at least in my personal opinion, right? And when we take a look at J&J's stock price, it's gotten crushed pretty heavily as well, from 154 down to about 109 at its lows. That is a cut of around 27%. And now that we're up to about 123, guys, I'm not looking to add more. I'm really looking to buy on the next leg down if we do get another leg down in the stock market in general and in these individual stocks. And the kind of rule of thumb here that I have is buying more on the leg downs, on the red days. Although today is a red day, in this period in time, the market actually had its one of the best 3-day streaks in history. So we're still up a lot over these past 3 days. So I kind of want to wait and see next week if we dump further. That is where I'm looking to buy more of these shares. But with Pepsi, again, I bought in the lower hundreds, a pretty decent amount. And with J&J, I've been buying in the lower hundreds as well, 110s and 115 area in general. And pulling up the Seeking Alpha tab for Johnson & Johnson, their dividend yield right now is 3%, so right in the same boat as Pepsi. Their annual payout, forward payout, is $3.80, payout ratio being 42%, which is solid. Again, if they cut earnings a little bit during this crazy outbreak that we're experiencing, they'll still be able to pay that dividend, so that's good. 5-year earnings, or rather 5-year growth rate, 6.3%, and their dividend growth is 57 years. So they're dividend king, guys, meaning they've grown their dividend for 50 plus years. So Johnson & Johnson, it's a blue chip. It's safe. It's not going to explode to $500 per share, but it's also most likely not going to go bankrupt unless the world ends, right? And it's in the same boat as Pepsi, again, being a safer blue chip stock that weathers the storm through crazy time periods. So another stock I'm buying right now, and I've actually mentioned this a lot on the channel already, is Disney, ticker symbol DIS. And just like Pepsi, Disney is one that I didn't have too much exposure to be honest, guys. And back in the 150s, especially when they launched Disney Plus and how well it initially did, I told myself, next time we see a substantial dip in the price, I didn't think it was going to be this substantial, right down to $80, but next time we see a big price dip, I'm going to start building my position in Disney. And let me mention this, guys. A lot of these stocks that I'm buying now, they're being bought in my Roth IRA, which, if you guys don't know, it's a retirement account, and it's not the investment itself. That's what a lot of people get it confused with, especially if you're completely new. A Roth IRA is not the investment itself. It's the investment vehicle that you purchase stocks and ETFs within. It's pretty much like a tax sheltered vehicle, right? And the purpose of it is to put post-tax income into this account, buy stocks, and they make gains. You gain dividends over time. And when you take the money out by 59 or whatever the age limit is, that money is going to be tax-free. So this money that I'm investing is meant to be for the next 40 years. I'm not touching this money for 40 years, which honestly is another reason why I'm putting it into these blue chip companies that I am very confident that they'll still be here in these next 40 to 50 years. And when we're taking a look at Disney here, guys, they're down a lot, from $150 down to about $80. So their stock pretty much went down almost 50%. And down in the $79 range, the stock has not been there since 2013-14. So the stock wiped out pretty much all of the gains from the past 7 years, excluding dividends, which is insane, right? And it makes sense because Disney's business segments are as follow: media networks, parks experiences and consumer products, studio entertainment, and direct-to-consumer and international. And the parks business, guys, their cruise line, all of that experience business, part of the experience business, that makes up 30 to 40% of the revenue. And with the CV outbreak, those businesses not operating right now, it makes sense why Disney is getting squashed again down to the $80 level. So honestly, this is an opportunity, in my opinion, to take advantage of this short-term hurdle that Disney has to get over, right, with their parks being shut. And you have to ask yourself, do you think the Disney brand is going to die because of this short-term slowdown, or do you think it's going to make it through? And for me, I think it's going to make it through. The company's going to bounce back. They're going to open parks in the next couple of months, whenever it does end up happening, and business is going to be back to normal. And I'm sure I'll thank myself in 10 plus years from now for building this position. And again, a lot of these investments are in a Roth IRA, but I also do own them in some other accounts. And if you guys follow my M1 Finance portfolio series, you know I own Disney and Johnson & Johnson in that account. But for honestly retirement, Roth IRA, it's really my focus right now in terms of long-term investments, just because of the tax benefit of it, right? So let's take a look at Disney's Seeking Alpha tab to show you all. It's not too crazy of a dividend payer, but it's not really a dividend play for me right now. I'm looking to really capitalize on the growth of Disney Plus, and the truth is, it's a dividend play for the future. It's not a dividend play for right now because their dividend yield is only 1.7%, but you can see they've only been growing their dividend for 10 years at a growth rate of 8%, with the payout ratio being very low in the 30% range, meaning they have a lot more potential to grow this dividend, which is why I'm thinking of it more as a longer-term dividend payer. I'm sure in 20 years from now, when Disney's more of a mature business, although it is mature right now, but it's still innovating. But as everything grows more, they have more earnings, I'm sure they're going to have a bigger dividend in the future. Whether it's 2-3%, it really depends on the stock price in general, because as stock prices come down, dividends go up. Either way, I think they're going to be doing well in 10 plus years, which is why I'm buying them in my long-term accounts. So let's get into the bonus ETF, guys. You have heard this one if you've been following my channel. It is SPHD. This is more of a diversified fund, obviously, right? It's a diversified investment, and this is also in my M1 account and in my Roth IRA. That's where I'm buying this investment or this ETF, right? And as of right now, their yield is a whopping 6-ish%, their dividend yield, which is incredible, right? And taking a look at their portfolio of assets, kind of where they're allocated in terms of the sectors, real estate is about 20%, which, yeah, if we see a downturn, real estate will most likely take a hit, but that's the risk you take, right? Utilities, a little bit more stable there, being 15%. Financials being 14%, which, again, a little bit unstable there, but it's the risk you have to take. Consumer staples being a little bit more stable, around 13% of the portfolio, and you can see energy around 9%, communication services about 8.5%, healthcare about 4.9%, and the list goes on. For me, this being a high dividend yield and a low volatility ETF, emphasis on the low volatility, I want it in my portfolio in times like this. And for the REIT that I've told you guys in the bonus section, if you stick till the end, is Realty Income. And this is one that I was actually buying more as we hit into the lower 40s because it just took a massive drop, guys. It was down 50+%. I couldn't pass up on that. And as I was buying down here, the dividend yield, the starting dividend yield, it was in the 6 or 7% range. And for Realty Income, looking historically at their dividend yield, typically when it gets to 6-7%, that is a pretty good time to buy, which is why I wasn't buying too heavily back when the dividend yield was only in the 3-4% range, because I was waiting for something like this. I didn't think it was going to happen this quick or this soon, but it did, and I was ready for it, which is why I'm buying more into Realty Income. And in general, guys, I'm not going all in to these investments. The whole idea here is to dollar cost average into the stock market, keep dry powder, because there's still potential for this thing, and by thing I mean the stock market in general, to fall down even further due to the uncertainty and due to the economic outlook that we have right now in the short term. And having this dry powder will allow us to buy more stocks. And another thing that I've been doing, guys, is I bought some gold. And this is another way that I'm kind of hedging against the dollar, the stock market, and my portfolio in general. And I think it's smart for maybe not every investor, but to just consider having a little bit of gold in your portfolio, because it serves its purpose, right? You can't be too heavy, at least in my opinion, in the stock market. It's very risky. I think it's wise to have a stock market investment account, maybe some real estate, have a little bit of precious metals, maybe have some land, maybe some farms where you have cattle. You guys get the point, right? Having it spread around. And I'm not to the point where I have houses and farms and all this stuff, but over a lifetime, it's the goal. That's the goal, right? To slowly build your assets, right? Have some metals, right? Have some stocks, and again, all the other ones we've mentioned. And yeah, that's kind of how I'm looking at it. And the key is just to have that dry powder ready to rock, guys, because you never know when the market is going to dump. So overall, that is it for this video, guys. I hope you all enjoyed it. Let me know down below in the comments what stocks you're buying. If you're not buying anything, let me know that as well. If you're selling stocks, I would love to know down below in the comments. And if you enjoyed this video, hit that like button for me, and also consider subscribing to the channel. And don't forget to claim your 2 free stocks valued up to $1,400 from Webull. That is linked down below in the description box. All you have to do is put in $100 and you'll get those 2 free stocks, again, valued up to $1,400. So I'll catch you all in the next video. Thanks for the support. As always, peace out.